All right, first up, what are we going to cover in today's workshop? Well, I wanted to give you just a quick history of moving averages, and of course, we'll define the three major types that people use. We're going to look at some of the general trading rules if you want to just trade off of moving averages, and we'll look at dual moving averages, which really leads us right into the decision point trend models, which use two moving averages to come up with our signals for each of the three time frames. All right. So really the history of moving averages, they were brought into the stock market after World War II because anti-aircraft gunners found that they used these moving averages in order to sight those enemy planes. And so it was a way for them to get a jump on it a little bit, or kind of, calculate what might be, which is almost what we're doing really with price, right? We're watching the price and hoping that by watching those moving averages, we can see, give us an idea of where price is headed or might be headed. Before I get too far into this, I do want to give Dr. Alexander Elder credit because much of the definitions I'm using in here and the trading rules came from the New Trading for a Living. Highly recommend it. It's a great primer, so something to consider. All right, so according to Dr. Elder, a moving average reflects the consensus of value within its time window. So that's where everybody is, over time, your price is moving the way it's moving. Obviously, you've got the moving average and price moving around that, and that's telling you what the actual value is when you look at a moving average that way. All right, there are three types of moving averages. There's a lot more, but these are the three I was going to cover today. But the ones we use on our charts, simple moving averages, of course, are very popular. Those are, regular average like you learned in school. Exponential moving averages, I prefer. I'll discuss that a little bit later. And then there are weighted moving averages, and there are a lot of averages that fall into this category, the triangular, the geometric, and there's just a bit more of them out there, but typically these are the ones, the simple moving average and the exponential moving averages are the ones that we typically use. So the simple moving averages, just like I said, it's pretty much how you learned it, in school. So you take your period of however many days, the number of components, atom, divide by the number of components. It's pretty straightforward. So there are some advantages. Mainly is it's just really easy to calculate and understand. It's part of the reason I use on balance volume. It's very easy for me to calculate and understand day by day. The disadvantages to simple moving averages is they have this thing called drop-off effect. This is kind of an extreme example, but imagine you have 10 data points, 10 price points, and then you divide by 10, obviously, to get your average. Well, then each data point equally contributes 10% to the average. So if you, for example, got a really large price drop at the, for the day, that's going to skew that average quite a bit. But as that moves down, that data point, that huge decline, and it moves down, eventually it's going to drop off. And now that's going to really change the character of your moving average on the right-hand side where we watch all the time. So that's my reasoning. Part of my reasoning for not using simple moving averages is because with the decision point trend models, we really are trying to concentrate on getting these signals, the buy, sell, and neutral signals. And so we need the weighting to be more on the front side of the data as the back side of the data, I guess. So the more recent side. So let's discuss that exponential moving averages a bit more. I'll show you how you can calculate that right here. So basically you come up with your weight multiplier. You then use that to come up, you weight each of the price points in your whole thing. You weight it using the multiplier, and then that helps you with determining how important it is to your data to make that average. And then there you go. Here is the calculation. It's all in chart school. I don't think there's any reason for me to go over that too closely. So what are the advantages? Like I said, I like it because it's better for trend following, because it puts greater emphasis on the more recent data. And then you don't really have that drop-off effect to the same degree that you might in a simple moving average. So when we talk about the moving averages, which ones do you use? That's a great question, right? I don't know. Do I want really short moving averages that sort of bounce around a lot? Do I want those really smooth, longer term moving averages? Well, here are the pluses and minuses. The short time frame windows they really whipsaw quite a bit. And I see that all the time in our short-term trend models, because we're looking at 5 and 20-day EMA crossovers. So that 5-day EMA is whipping around a lot. So you're going to get a lot of whipsaw and possible signal issues there. Dr. Elder says that look at the length of the cycle that you want to really put the most emphasis on, and then take half of that, and that determines what your moving average might look like. All right, so general trading rules that Dr. Elder uses. These are pretty straightforward, and obviously I think we all kind of use these and just tweak it. But if you're going straight off what you look for with moving averages, you want to see it rising. Obviously, your moving average should be rising. You want to trade from the long side when that's happening. You buy those price dips. We were just showing how that one chart showed that price had come down, touched that 20-day EMA, and then moved itself, boom, right off of that. So that's where you want to start buying. Even, the EMAs are continuing upward, but the price can go down and test it. And then he says to set a stop below the latest minor low. And then you raise your stop, obviously, as prices move higher to protect your investment. So here's what I'm talking about here. So while the EMA is rising, you want to stay in. Price comes down and tests it. That might be a place to add on positions. You come back up here. So here is where he's saying to enter when the EMA starts to rise. And you've got that happening over here as well. And then as the EMA starts to turn, that's when you're supposed to get out. And of course, with an EMA, you may not understand the calculation so well, but with an EMA, if the price closes above the EMA is going to start moving up. And if it closes below it, it's automatically going to start moving down. That's just how they work. So, you're talking about entering on rising EMAs and, those getting out over when they top. It's a pretty simple way to look at it, and something to consider. But yes, as soon as price moves below that EMA, okay, the EMA is going to top. So you are kind of trading on the crossovers with the EMAs. But like I said, you should read more in Dr. Elder's book. I just wanted to give you a taste of how some traders use those EMAs to trade. So when the EMA is falling, it's pretty much the opposite as far as where you hit your stop. It's just the opposite of what we just went over, so I'm not going to cover that too much. But here you go. The EMA is starting to fall. That's when you get out. EMA starts to turn up. That's when you're supposed to be getting back in, right? So basically, you enter when the EMAs start to fall, and that is going to be when price drops and closes below that EMA. The other rule is if those EMAs are trading sideways, if you're just getting, you're getting what I call braiding when I use my moving averages, when they just start to cross over each other and move sideways, you have a very directionless market or stock there. And so you don't want to really use the trend following method. It's not going to help you if trading is mostly in a trading range. So Pay attention to that. All right, a few other things on moving averages. They can be used to determine your support and resistance areas, which is what we were just talking about as well. I know that we do talk about support being found on moving averages, or resistance being there for moving average if price is coming back up to it. We use moving averages for indicators. I especially do with DecisionPoint, because our trend models are simply crossovers of different moving averages, and then we label them depending on which direction they're going and what side of other EMAs they're on, but I'll talk about that in just a moment. You can also use the Bollinger Bands and construct channels around your moving averages. I'll just go over and show you really quickly what that might look like. So I'm just going to take, I always do this. I lose my mouse. Nope, there it is. Okay. There it is. All right, so I've got a bunch of moving averages on here. Let's just take the, we're going to take all of them off but the 20. And then we're going to add the Bollinger Band. Oops, here we go. And there's the 20, that's what we're talking about, and we're looking at two ATRs, I guess that's what it is, two sigmas. I have to remember my math. So basically I took a Bollinger Band that's going around a simple moving average. Well, obviously that average is not matching up with my 20-day EMA, so I'm going to change that just to make it a little more clear to a simple moving average. Okay. There we go, because see, now you can see that it matches. So you can add the Bollinger Bands to your moving averages and use that as touch points to get in and out of the market, depending on whether they puncture those bands or not. So that's one thing to consider as well. All right, dual moving averages. This is where we look at the crossovers, but Dr. Elder calls it a value zone, a consensus of value, because you're looking at the long-term, for example, EMA, and then a shorter-term EMA, and so that space in between, he's saying, is that consensus of value. We use dual moving averages often for our trend model signals, and other people use crossovers for signals. And here are the trend models. So I just wanted to talk about these because it's a great example of how you can use dual moving averages to study and look for price pivot points. So the short-term trend model for DecisionPoint, we use the 5 and 20-day EMA. And as I said, it's based simply on their crossovers, but we look at them in relation to the 50-day EMA, because if the crossover occurs above it, that's a neutral. If the crossover, negative crossover, occurs below it, then it goes into a short-term sell. So that's why we say in relation to. Intermediate-term trend models, same thing, 2050 EMA, but we use that in relation to the 200-day EMA. So if a 20-50-day negative crossover occurs above, it's a neutral. If it occurs below, then it's a sell. Long-term trend model, all we are looking at are the 50 and 200-day EMA crossovers. All right, well, we talked about that. So here is the long-term and intermediate-term trend model signals, just to give you a feel for it. There's your 50-day EMA crossing above the 200-day EMA, so that's a long-term trend model buy signal. This is an intermediate-term trend model buy signal, a positive crossover. Basically, anytime I get a positive crossover of my dual moving averages, it's a buy signal. But then there's those neutrals and sells. And like I said, for example, this is a good one. You've got the 20 crossing below the 50. up here, that negative crossover, but it occurs above the 200-day EMA, so that becomes a neutral and not a sell signal. So that's what I mean, crossing above or below. That's how I determine if it is a neutral or a sell. And here are the short-term trend models, those 5 and 20-day EMA crossovers. And again, same idea. You get the negative crossover above the 50-day EMA, then it's a neutral. When they're below those crossovers, like, well, it's not an actual crossover, but if it comes in below the 50-day EMA, then it is a sell signal. All right, so here are some of the takeaways. And like I said, I'm going to look at a few examples of how I use it, and then we'll talk about the poll. But what I want you to really think about when we're talking about moving averages is really very important to understand the differences between a simple moving average and an exponential moving average. And, you know, everybody has their preference. Like I said, I use the EMAs just because I want to put more emphasis on the near-term data points. Because simple moving averages, you do have a drop-off effect can be a problem, and I'm going to show you a chart about that in a moment. And then, of course, using dual moving averages is a great way to look for support and resistance, find that value zone as the consensus of value, as Dr. Elder had talked about. So yes, be sure and pick up this book or thumb through it. This is where I got my information as far as the trading rules and that sort of thing. So if you wanted to learn more about that, I would recommend you go check out his book there. But let's look at just a few ways we can use our moving averages to our advantage. All right, so here we had the Bollinger Band. Remember, I had put around that 20-day EMA. Let's go ahead. I prepared a chart that shows you, and I'm going to show you down here what I'm doing. It has the 200-day exponential, the 200-day simple moving average, and then the exponential and simple of the 50-day EMA. The thick ones are the ones I use. Those are the EMAs in the chart above. So I just wanted to let you look at this and see what the differences are and why drop-off effect is something that you may want to consider. Look at how, first of all, so we have these 50 and 200-day EMAs. The 200-day EMA, that's your simple moving average. See how they're very close together here at the end. But where do they really move apart? They move apart when we start seeing these really big moves in one direction or another. And that's really, to me, where I like to use these moving averages. So this is a little cleaner over here. But as you can see, we had this top back here, and we had a huge gap down. The moving averages were almost equal at that point. But then when it started to, it popped up, but then it started to come back down. Notice that the EMA started to react faster. It started to move lower faster than the other, the simple moving average, the 50-day. Now, in the 200-day example, they do tend to travel very closely because they are long-term. But again, you can start seeing the drop-off effect when you end up losing something large like this on the back end. It's going to change your simple moving average by a bit more. I also decided to look at this one anyway as the what the trend model would have done. If we used the simple moving averages for our long-term trend model, we wouldn't have gotten that crossover until almost mid-March, whereas we got it a bit earlier, I would say, at the end of April. So we knew we were moving into a bull market configuration. It came after some consolidation, obvious that deep decline. So I got a crossover a bit earlier here for the long term than I did back here. And so it's, again, a matter of preference. I recommend you put these on a chart and maybe go back and look at the different crossovers or how they react. I have another one here too. And I think I did this one. Yeah. This is the one I believe I was going to look at. Was it this one or? Yeah, I think it was this one. All right, so on this one, and we'll come down, again, the thick ones are my EMAs that I always use, and then the skinny lines are your simple moving averages. So in this case, where did we get the buy signals for the EMAs versus the simple moving averages? Well, here you got the buy signal, the 20-day EMA crossed back above the 50-day EMA, and that's when the DecisionPoint trend model would have kicked in that buy signal. But notice we didn't get it until later on the simple moving averages. It just took longer for it to get back up there because it was affected somehow by the data it had probably on the back end, where we started to really see some margin being put between the 20 and the 50-day simple moving averages. So again, really interesting to see the effect of an EMA versus a simple moving average. They do tend to travel very similarly, but there are times when they do not. And I think that it gives you some extra information that you might find helpful or interesting. So let's go ahead. I am going to call up gold. Let's look at gold right now, because I am watching these moving averages fairly closely right now. So these are my EMAs. And again, so long-term trend model, how do I get my signals? 50 and 200-day EMA crossovers. So back here in the beginning of January, we got the moving average crossover in the long term. So that gave us a long-term trend model buy signal. And also put gold in a bullish configuration, in a bull market configuration. We kind of say that when you get that crossover to the upside, you're now in a bull market as far as that stock or index or whatever you're looking at. You're now in a long-term buy. You're in a long-term bullish situation. And so that's when you want to start considering getting in or holding, is when you have that 50 above the 200-day EMA. It's obviously telling you have some strength in the longer term. The other crossover, notice we got the buy signal back here. This is what I call braiding flat EMAs. So despite getting that signal, if you really had followed Dr. Elder's advice, you probably wouldn't have gotten in until you really started to see some margin being put between these EMAs. So that's another thing to think about with the EMAs. And right now you can see I just got a short-term trend model buy signal on gold. I've been waiting for that breakout, and we did get that yesterday. So that pretty much concludes my my presentation on moving averages, and I'll just bring you back again so that you can see not only that is the book, but again, remember that these averages are different. They're not created equal, and you have to determine what you really want on your charts to determine, what is your style of trading. Do you want to put more emphasis on the near-term data, or do you want very equal across the board? And I'll say, I know Mary Ellen McGonigal also, I know she uses the 200-day simple moving average. And I was like, why do you choose to use the simple moving averages? And she said, well, especially with the 200-day simple moving average, I know a lot of money managers out there. I know a lot of, analysts use that particular moving average consistently. And so I want to have that same understanding of a chart. So she chooses to have the simple moving average because she knows that across the board, a lot of her colleagues use it. So for me, I'm all about EMAs because that's what DecisionPoint uses for our trend models. So to each his own. All right, Tom, that pretty much wraps it up. Maybe we should go ahead and take a look at the poll, because I did ask about moving averages and which kinds you tend to use. All right. Wow, I'm surprised we had the mix like you do, because I know I'm sure you get questioned regularly. Why do you have an EMA and an SMA?
Yeah, I get that question a lot, and mostly it's just because I'm weird.
Well, we already knew that, but...
Yeah, for me, I can understand why you use the EMAs because you're looking for the crossovers. And so I think using
Signals.
one as an SMA, one as an EMA, I don't know, kind of apples and oranges kind of a thing. And I do think your EMAs, as you showed on the one chart, by using the crossovers, the EMAs are gonna cross, I would think, quicker. I haven't really thought about it, but I would think they would cross quicker and give you signals quicker than the SMAs. So that makes sense to me.
Mm-hmm.
But for me, the reason I use the SMAs for the longer term is it just doesn't make any common sense for me to take a 200-day moving average, which is, obviously we're taking a lot of data and it's over a long period of time. So it's a long-term moving average. And so applying more weight to the more recent data to me doesn't make any sense. I'd rather take like a 20-day EMA because that's my short-term, really quick moving average that I want to follow, and I'd prefer to get that signal quicker than the 20-day SMA. But for a 200-day or even a 50-day, for me, I like the SMA just because, again, I don't want to look at the more recent data in a long-term moving average. The long-term is the long-term, and so I just kind of keep it that way. So I never followed anybody in particular. There was no rhyme or reason to it. It's just kind of what made sense to me is to have the exponential with the shorter term moving averages and the simple with the longer term. But that's why I do.
No, it makes complete sense. I mean, the more data you have, the less important, I guess, that drop-off effect will have because you have so many other data points. It would have to be an extraordinarily different, drop or rise that would really affect it by too much.
Yeah, and I think that one of the takeaways too is that you're going to have a lot of technical traders and maybe some that don't pay nearly as much attention to technical information, but they may still use like the moving averages. And so you're going to have a lot of folks looking at both the SMAs and the EMAs. And I just think it comes down to each individual style and strategy and what seems to work best for you. I don't think there's one right way or one wrong way to do it. I think it's whatever works.
Oh, absolutely. Totally agree. It depends on your objective. So anyway, boy, that went fast.
Yeah, good job, though. Good job. It's always good to go back and do some refreshers. I know a lot of folks that are watching the show probably do use these different moving averages and may wonder why we use different ones. And then there may be some others out there who may be new to technical analysis. And I think that was a really good educational segment for them. So good job, Erin.
Excellent. Thank you so very much.
Candlesticks, when should you use them and when should you ignore them? And this is a bigger part of technical analysis. A lot of times you need to ignore indicators and you need to know when to ignore indicators. So when the bigger trend is up, I ignore bearish candlestick patterns like a bearish engulfing, a shooting star, or a dark cloud cover. Instead, I only use candlestick patterns when the trend is up, and I only use bullish candlestick patterns then. Let's look at an example. Here we have Rockwell Automation, and we can see a pattern of higher highs and higher lows developing. And we get this pullback here into August, and we get a bullish engulfing. Now this is one I'm interested in because I think the bigger trend is up, and I think this bullish engulfing is signaling the start that the short-term downtrend there is going to reverse. And not only do I look at the candlestick reversal, I look for follow-through as well. And you can see we got follow-through with the resistance breakout, and then we got some good volume coming into the stock. And yes, sometimes I do use volume on individual stocks, but this is an example of when to use a bullish candlestick pattern.
Here's how to add a moving average for the volume on your charts. You can't use this volume component here, so go down under Indicators, select Volume from the drop-down menu, and then put the period that you'd like on it, and you can specify the color of the moving average line, click Update, and that will give you this nice little line on here so you can see if it's above or below average volume.